UMH Properties, ticker UMH, delivered a really solid earnings beat for the second quarter of 2026.
They really did.
Yeah, earnings per share came in at 5 cents, which totally crushed the consensus estimate of right around 2.8 to 3 cents.
Right. And total revenue hit $71.64 million. So that sailed past the $60.76 million consensus estimate.
That's a 7% year-over-year increase, right?
Exactly, 7%. And normalized funds from operations, or FFO, that reached 25 cents per share.
So guidance-wise, management actually maintained their full-year 2026 normalized FFO range at 98 cents to $1.04 per share.
Which the market obviously liked. Shares popped, between 1.2 and 3.3% in the following trading sessions.
Yeah.
Pushed right up into the mid-$15 range.
So with those headline numbers out of the way, we really need to unpack the underlying operational mechanics driving this beat, because beating revenue estimates by over $10 million.
Yeah, that's huge.
It is. So we're taking our stack of earnings transcripts, the macro real estate data, to figure out exactly how UMH engineered that.
Right, because if you're looking at the real estate sector right now, you know how brutal the environment is.
Oh, absolutely.
High interest rates are locking up transactions, inflation is squeezing margins, but then you have this manufactured housing company throwing off metrics that look, well, more like an enterprise software business than a property manager.
Yeah, so we have to figure out if this is just a temporary bump from a tight housing market or a permanent structural advantage.
The answer definitely leans toward a structural moat, and you
Right.
see it immediately when you look at their site-level metrics.
Right, the same property net operating income, the NOI.
Exactly. It grew by 8.8%, hitting $37.24 million.
Wow.
Yeah, achieving nearly 9% organic NOI growth in this rate environment. Without massive acquisitions, it's incredibly difficult.
And when you drill into that, rental and related income increased by a healthy 9% year over year.
Yeah.
And occupancy is trending up too. Same property occupancy increased by 110 basis points, so up to 89.4%.
But the data point that really jumps out, the one in their specific rental home program.
Oh yeah, operating at basically full capacity.
Yep, a 95.3% occupancy rate across something like 11,200 units.
Which means practically zero functional vacancy.
Exactly. Once you account for unit turnover or maintenance, 95.3% means every habitable unit is generating cash. There's no slack in their system.
It really functions like a high-retention SaaS business, a software subscription model, but for real estate.
It really does.
Because in traditional apartments, if a landlord hikes rent 10%, you just rent a U-Haul for $100 and leave. But here, the residents own their manufactured homes, they're just renting the land.
Right, the land lease model.
So the occupancy is incredibly sticky. It costs thousands of dollars to move a whole house, pour a new concrete pad, do the utility hookups. So if UMH raises lot rent by $50 a month...
It makes 0 sense to spend $5,000 to move.
Exactly. But I have to ask, is this 95.3% rental occupancy just a temporary thing because the housing market is frozen? Or is this, the new normal?
It's a permanent advantage, but it's definitely being supercharged by the macro environment right now.
Right.
The high switching costs are the foundation, but hitting 95% capacity, that's a direct symptom of the national affordability crisis. Standard single-family homes are just entirely out of reach for a massive segment of people right now.
Yeah, manufactured housing is really a critical relief valve.
Exactly. But if they're virtually tapped out on rental capacity, that brings up the question of where the next leg of top-line growth actually comes from.
Right, they can't just hike rents forever.
Exactly. So beyond collecting rent, management is actively driving bottom-line growth through really aggressive home sales.
And the sales figures were record-breaking this quarter, right?
They were. They hit a quarterly record in home sales at $11.5 million. That's up roughly 10% year over year.
Yeah.
And management noted that momentum is continuing. July sales were tracking a full $1 million ahead of last year.
Which is a huge forward-looking indicator. It shows demand is holding up. And at the same time, they're managing margins carefully.
Oh, absolutely.
Their operating efficiency actually improved. The same property expense ratio dropped by 40 basis points to 38.1%.
Right, meaning more of that revenue is flowing straight to the bottom line. But executing that aggressive home sales program across 145 communities, that requires a lot of capital flexibility.
Yeah, and their balance sheet moves were super active. They amended and extended their unsecured revolving credit facility,
Bumped the potential availability up to $600 million.
which is huge. But the crazy part is they negotiated a reduction in the interest rate by 35 to 40 basis points.
In this environment, that's a massive vote of confidence from the credit markets.
It really is. And they also raised $7.6 million by issuing Series D preferred stock.
Right. It's a very measured way to bring in cash without diluting common shareholders too much.
Right.
But, it makes you wonder why they need so much immediate liquidity.
That's exactly where I want to push back on management a bit, because looking at this aggressive inventory pipeline they're building,
Yeah.
the sources show they rented 193 new homes this quarter, but they have 100 sitting on site ready to go and another 300 currently being set up.
That's 400 homes in the pipeline.
Right. Buying those, transporting them, setting up utilities that requires massive upfront cash. Are they front-loading too much capital expenditure?
That's your question.
Because they reported $45.6 million in operating cash flow for the first half of the year.
Ooh.
Laying out cash for 400 homes, doesn't that risk a liquidity crunch if demand cools off?
It's the classic real estate tightrope. The cash goes out months before the first rent check clears. But you have to view that CapEx through the lens of that $600 million credit facility.
So that's the shock absorber.
Exactly. They're willing to trade near-term cash burn for long-term NOI because their internal data that 95% occupancy tells them lease-up risk is basically zero.
They know the second the house has power and water, someone is signing a lease.
Exactly. And it ties right into management's strategy. CEO Samuel Landy actually credited the quarter's success to, quote, years of hard work investing in and growing the company.
And he's talking specifically about their infill strategy there.
Right. Instead of buying up expensive new communities, UMH focuses on organic expansion.
They're filling vacant lots within their existing 145 communities, which are mostly in the Midwest and Northeast.
Yeah. And bar chart data points out that manufactured homes cost 30 to 50% less per square foot than traditional site-built homes.
So they're deploying cheap assets into markets where traditional housing is locked up by high mortgage rates.
Exactly.
It's like a half-empty hotel, right? You already own the building, pay the taxes, pay the staff. You've already laid the expensive sewer lines.
Right. The fixed costs are sunk.
Yeah, so every new manufactured home placed on an existing empty lot that represents pure margin expansion.
Almost all the new revenue flows to the bottom line.
And you get paid to wait for this strategy to play out because they pay an attractive 90-cent annual dividend.
Which is around a 5.66% yield right now?
But does this infill strategy have a natural ceiling? I mean, once the hotel is full, you can't sell another room, right? Once the communities are full, what happens?
Well, physically, yes, there is a ceiling.
Yeah.
But they have over 27,100 developed home sites. And with 89% occupancy, they still have roughly 11% of their pads available for immediate infill.
Oh, okay. So that's roughly 3,000 vacant pads.
Right. So even setting up 300 to 400 homes a quarter, they have years of inventory left.
So the runway is still super long?
Very long.
But if you're a retail investor, you really have to weigh the structural risks unique to this sector. It's not a guaranteed march to 100%.
No, definitely not. Regulatory pressure is a huge one. State and municipal governments are heavily scrutinizing rent increases in these communities.
Which makes sense politically. The residents are basically trapped because of those massive switching costs we talked about.
Exactly. And if widespread rent control gets implemented, it could severely cap UMH's revenue growth. They wouldn't be able to offset local inflation or rising taxes.
And that's totally out of management's hands. But there's also the interest rate sensitivity, specifically with chattel loans.
Right. This is huge. Buyers of manufactured homes often can't get standard mortgages because they don't own the underlying land.
So they have to use these specialized chattel loans.
Yeah, personal property loans.
Yeah.
And those carry noticeably higher rates than standard mortgages. So when the Fed raises rates, it can instantly suppress demand for new homes.
Though, to be fair, UMH uses their own internal sales and finance subsidiary to help buyers navigate that, right?
They do. It helps them offer slightly more competitive rates and terms, which mitigates the risk a bit.
Which explains how they hit record sales anyway, but they're still subject to the broader credit markets. And then there's the third major risk. Zoning and NIMBYism, not in my backyard.
Oh, this is the persistent headwind for the whole industry. building or expanding communities faces fierce local resistance.
People worry about property values or straining the local schools and infrastructure.
Exactly. And that limits footprint expansion entirely. You can't just buy farmland and build a new community easily.
It's a double-edged sword. It creates a massive moat for UMH's existing properties, but it traps them from expanding outward easily.
Right. They have to rely on that infill strategy.
But looking forward, there's actually a massive catalyst that ties all this together. It's a huge lobbying effort.
Yeah, the September 2026 event.
Right. The sources say that in September 2026, UMH is going to display two-story HUD-code manufactured homes right on the National Mall in Washington, D.C.
Literally putting the product where every federal lawmaker has to walk past it.
Exactly. So I want you to really ponder that. What happens if highly visible lobbying efforts like this actually spark federal shifts?
Like if they force zoning changes or get Fannie and Freddie to heavily subsidize chattel loans.
Yes. A move like that could drastically alter the valuation multiples of operators like UMH moving forward. Follow the show for daily earnings coverage.